taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Hey guys, welcome back to the Total Money Management Podcast. Tom and Steve are still here, so I haven't got rid of them yet. But how you doing, gents?
I'm good, mate. How are you?
Yeah, good. Look, we're changing it a little bit. We're going to be talking more about current events. We've spent the last, feels like 6 months talking about principles, core concepts of investing, real areas that we believe people should learn and look into, and we've had some general consensus feedback really from the viewers or listeners on more current events. So that's what we're going to do today. We'll talk about a review 2023. We'll talk about what we think's going to happen or not going to happen in 2024. And I might hand over to Steve. Tom, if you want to take over.
Yeah, thanks, mate. What we want to do is just give people a framework to look at current events in. The reason why is because if you've been listening to us from the start, you'll probably understand that the world is changing quite rapidly from the way it's been for the last 30 to 40 years. And so you have to toss out your old way of thinking because there's a new sort of paradigm. And so what we're going to do is what we do through for the subscribers is look at current events, but it's no good just reading something and going, oh, that's interesting. What you want to do is be able to put it into a framework where you go, okay, that confirms the thesis on demographics or COVID or deglobalization and stuff. So that's the general idea. And in this first one, we're going to be talking about predictions and stuff. So, Tom, got any? Notice anything? What did you notice in 2023?
Oh, look, I was actually just reflecting on this the other day. And I think it was the first time I kind of understood inflation. Obviously, a fair bit younger than you. So
just a little bit, mate.
Yeah.
Not a fair bit.
It's been kind of a concept, right? Like for me anyway. Last year really felt it. Like cost of living seems to have gone through the roof. It was, the first time I'd really started looking at houses as well. And, when you're talking to the banks about what you can borrow, that's when it starts to hit home. Like these interest rate rises are having a real impact. And honestly, I was just sitting there scratching my head a little bit going, well, for those who aren't in the market already, how do they get in? Yeah.
You think of the Sydney property as about 1.4 million is the average, then you've got to have basically 350,000 as a 20%. Now, most, some people can get 10 and stuff like that. But the reality is that if you get a 10% deposit, well, it just means you've got to borrow more anyway, so you're on the hook. But you sort of think about it and you think, God, that's, 300 grand in cash. You think if you're saving 30 grand a year, which most people wouldn't be, that's like 10 years. By the time you get to 300, the price has gone to 2.5 billion.
What's the average or median wage in Australia? Like 65 grand when you take out the outliers.
Yeah, the average is 95, but the median is about 60. Yeah. And so if you put two people together, say 120, throw in a few benefits, 130, I mean, who can save 30 grand out of that?
You might get a shed in about 10 years.
Oh, well, yeah, I was chatting to a broker the other day, and he goes, look, for someone who's on about 200 grand, the banks will probably lend them about 650,000.
Yeah.
And you look around.
Which is not much, really, is it?
Well, not really.
Well, you're not going to get much of a house. You might get a 3-bed out in the middle of nowhere.
Yeah. Obviously, how much you spend on day-to-day living all affects the serviceability as well. Anyway, that was one of the things that I've...
Did you adjust your spending? Did you did you at some point go, oh, I'm going to skip the corn chips or the coffee or, like...
Definitely didn't skip the corn chips.
Yeah.
Hey. No.
Right.
In fact, probably spent more this year.
But why? But why? Because I mean, you earn a good income, right? It's fair to say you're doing all right. So did you think this is a real shock? But, oh, well, who cares? I'm going to buy 3 coffees a day like I do anyway. Seriously, is that
100%. Yeah.
Oh, okay.
Yeah. Like, I wasn't happy about it, but I wasn't going to change what I'm doing.
Yep.
And I don't think I'm the only one.
No. Well, look at if you look at the stats in terms of, everyone always talks about restaurants have fallen, blah, blah, blah. Oh, that's interesting. What about you, Jacob?
Well, we're just looking at consumer discretionary spending, and I remember I might have mentioned this a couple of weeks ago, but the Treasurer has, I mean, there's stats out now saying that consumer discretionary spending in Australia is kind of maintained. It's dropped a little bit, but it hasn't gone nowhere. So that explains why Tommy goes and buys his 3 coffees a day and his corn chips, because people are saving elsewhere. I mean, he might not be going on holiday this year or 2 holidays a year, but they're still wanting to live a somewhat lavish lifestyle. As well as that, mortgage repayments, bills are being paid, and all the main things are being covered. What we've already spoken about over the last few months is that there will probably be an end to that, the discretionary spending side of things, but we just don't know when. So if we have a few more interest rate hikes, then we might start, and people obviously going from a fixed interest mortgage to a flexible interest mortgage now going up to 6-7%.
Variables,
Variable. We might actually start to see that discretionary spending come off, and we'll go into a bit of a, not depression, but a semi-depression over the next few years.
Yeah. Well,
because of that.
Yeah. Well, that was one of the things about the predictions for 2023. What I like to do is at the start of every year now is go back and look at what people were saying at the start of last year or the start of 2022, because one thing you notice at the moment is that this time of year everyone comes out with predictions, right? You know, what do you think is going to happen in 2024? The thing that always amazes me, and I always harp on about this, and you guys know it's coming, is you listen to experts, right? They all say, oh, yeah, you know, market will go up 8 to 10% this year, right? Now, that's the long-term average, right? Not the geometric average, but the arithmetic average. But my point being is no one ever says, yeah, 30%. It's going to absolutely kill it, right? Or no one says, yeah, I'm expecting a 20% decline. Right, everybody in the mainstream says exactly the same thing, which is always they end up around 7 or 10%, right? But my point being, you go back and look at what they said in 2023, which was sell US stocks, US economy is going to tank, China and buy China stocks, and exactly the opposite happened. But what you find is that no one actually goes, oh, Jesus, I got all that wrong. Oh, I had a shocking prediction last year. No one talks about it. Everyone just goes, yeah, this year will be 7 to 10%, and here's why, blah, blah, blah. It's like, hang on. The interviewer should say, mate, it was terrible last year. You got it completely wrong. Why should we listen to you this year? And yet everybody's going to go out and go, oh, yeah, okay, I can expect 7 to 10%.
Yeah, well, markets go up, 70% of the time, so it's safe.
Well, exactly, yeah. You're already on a winner if you go, I think the market will go up. I'm not sure how much, but I think it'll go up. Most people go, oh, that's good.
He's an expert.
Yeah, and like you say, it goes up most of the time, so it's not exactly like...
70% sure that it'll go up. Well, I was wondering how many times has the market actually delivered an average return of 8%?
From memory, it's now, this is in the US... but it's something like 6 years out of the last 85. So in other words...
Not often.
Not often. And that's my point.
Might do 2%, might do 20%.
Exactly. And that, I'll tell you a little story. And I read this ages ago. There was this young guy and his dad, right? And they're in the finance industry, and they're at this finance dinner, and the MC says, you know, whoever can guess what's going to happen to the market tomorrow, you get a free chook or a free dinner or something, right? And so everyone's got to put in their, write on a piece of paper, it'll go up 0.5, it'll go down 0.2 or that sort of stuff, right? So the young guy finds out, They do the draw, right, and the old man wins, right? And the old man, the market goes down 0.25 or something, right, which in standard terms is like a 1 in, 100 event. And the young kid says to his old man, like, how did you know it was going to go down like, 0.25? And he said, I didn't. And he said, I knew everyone else was going to be going, 0.4, 0.38. So I just took an outlier. Because he was going to end up being closest if he said +3 or -3. And he just went with -3. So my point being that all these predictions, when you look at the statistical distribution of the market, everyone's just playing it safe.
Yeah, like you're taking a guess.
Yeah. But they're also taking a guess knowing that 7 out of 10 times they're going to be right anyway.
Yeah, no one's going to come asking questions if you said it's going to go up 10% and it goes up 11% or it goes up 8%. So as long as it goes up by the end of the year, it's interesting. But for me, 2023 was, I think I said this before the podcast started, like it was a year of war. People were at each other's throats. We had Russia, we had Ukraine, we had Israel and Hamas, it was all just going tits up. We've had China housing collapse with Evergrande going bankrupt. It's been awful, yet the market's risen. Just keeps plodding along.
Hallelujah, brother.
And I mean,
you got to love rationality.
Oh, it's insane, isn't it? But I mean, it begs the question: has all the war fed into the increase in stock prices?
Yeah, probably. I think the thing about the US, everybody said the US would go in. Not everybody. Lots of people said the US would go into recession in 2023. Now, the reason was because the yield curve had inverted. And the argument is once the yield curve inverts, which means that, bond yields are going to be lower, therefore the economy is going to sink, right, didn't play out. And that's one of the reasons why I say we're in a new paradigm, because what a lot of the people think is, or didn't account for, was the huge increase in government spending. If you look at it, it's something like 6% of GDP. Now, US GDP is about 25 trillion. When you do 6% of that and you put it into the market, which hasn't been done for a long time, you forget how powerful it is. And with interest rates up at 5%, lots of rich people got even more money because they were getting 5% on bonds, right? Whereas we've been used to 1%, which is, basically nothing, right? So from that point of view, that's why I'm saying you've got to look at the world differently, because we're in a new ball game.
Yeah, I think heavily it was obviously Magnificent Seven.
Yes.
Carried the market a bit as well in 2023. I'm not so sure that's going to continue to be the case, because nothing can keep flying forever.
Yeah, absolutely.
That was in a way to be expected, right? Because 2022, they all did horribly.
Absolutely. Yeah. Well, too.
Yeah, I mean, what did Apple was down 30% in 2022 and up 30% in 2023. So
I think it was down 30, up 60 or something.
Yeah.
They're just, but it isn't funny, because when you look at crypto or NFTs or the Magnificent Seven, what you're seeing is the idea is the market sort of normally distributed, which means, it's fairly even. But what you see now, because of technology and stuff, particularly being able to, buy and sell at the click, is you get this mad rush into like the top 7 stocks, right? Everybody gets into the top 7 and it does really well. And then, like you say, Jacob, I wouldn't be putting my money on them this year because they've had such a spectacular year.
Yeah. At
some point it'll flip.
Well, it's funny you're whispering well too in my ear. Then, but it is right. Like at the beginning of 2022, they had such a terrible year. They were the bottom 3 of the sector.
Yep.
They were the top picks almost for well too. Now they're at the top. They've had an absolute boomer. So we're not going to be. They're not the top picks for this year.
Yeah.
Because there's another bottom 3 that have excellent
energy.
Yeah, it's just about that agile investor mentality. We're like, okay, we've had a big win. We know that the US cape's at 32 and probably going to increase again this year. So let's have a look at what's actually cheap and what's got a decent yield.
Absolutely. My only I had a look during the week, and the screaming non-financial advice buy is energy. Energy looks really, really cheap. There's a few, emerging markets look really good. Small caps look really good because they've all been absolutely hammered compared to the S&P and particularly the NASDAQ. It's just gone absolutely nuts.
Well, I'm looking at the ASX 200 chart now, and obviously since the start of November, it's gone up 13%. Everyone's stoked. But when you look at the chart, we have been at this same level 5 times since the end of 2021. So we haven't broken new highs.
So we haven't gone anywhere, sort of thing.
Well, depending where you bought it, right?
Yeah.
So if you would, for some reason, put all your money in at the end of 2021, you would have just been really disappointed a lot of the time, and right now you'd be just praying to break even.
Yeah.
Obviously, that's not how most investors deploy cash into a fund like this, but it's just interesting. We're at that same level every time we've hit this. So from a technical analysis perspective, it'll be interesting to see what happens here.
Yeah.
Is it going to retrace, or is it going to pull back and continue to rally?
Imagine hoping to break even at the top of an all-time high,
I mean,
particularly in the US.
That sounds like 2016 Bitcoin for me.
Well, you look at the when was it? If you look at the stats, the market spends 5% of its time at an all-time high. So it's that weird thing of market drawdowns where you don't realise it, but you spend, it's something insane, 60 to 65% of the time getting back to where you were previously. So you look at a point and go, well, 2000 to 2010 was a terrible decade because in 2000 the Cape ratio was 44 and, we'd had a tech boom, blah, 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 blah. And that's what I mean. That's the same what we were just talking about off air, saying, 23 was great. And it's like, well, yeah, because 22 was really bad. So in actual fact, you didn't go anywhere.
Well, it feeds into what we talk about every day, which is make sure you've got your own criteria, make sure you have your own strategy.
Yeah.
Because if you're just launching your money into the market once a year because you got a bonus, that's not necessarily going to work.
Yeah, that's why I say, that's why I'm a little bit sort of sceptical of experts, because at this time of the year, what I've noticed over the years is people get influenced at the moment because you're on holidays, so you get a chance to read stuff. You read stuff and go, that sounds really plausible. I'm going to go into lithium miners or, something that has caught your attention that if you were doing a 9-to-5 job during the year, you haven't sort of been paying that much attention. So people then act on that. And so that's where I think it's dangerous, because what you find is, I don't know about you guys, but my feeds, social media feeds, are just absolutely full of every man and his dog and every woman and her dog making a prediction. Like this year it's going to be copper, or this year it's going to be, property's going to rise, blah, 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 blah. And it's sort of like, I was just thinking about it last night, but you think, if I said to you, I think 2024 is going to be a good year and it's going to go up 11%. Now, you have to think, well, how the hell would Steve know that? Because there's 365 days this year. He's got no idea what's going to happen tomorrow onwards, right? And that's why I say you think COVID, you think the war, right? All of these issues come up where the experts go, nobody could have predicted it. And it's like, okay, but why did you not acknowledge that in your original thing by saying, listen, mate, we just can't predict because, we don't know what's coming.
Well, yeah, absolutely. Objectively, right now, the Cape's at what, 32? Touch over 32.
And climbing.
Which is, batshit crazy. Looking at the S&P 500 now, it looks like prices just kind of bounced off that 47.50 mark.
Yep.
Last time it was there, sort of tail end of 2021, the market continued to fall 26% over the following sort of 300 days, just looking at this now. So what we've got is a bit of a confluence, right? We're currently sitting at all-time highs for the S&P 500.
Yep.
We know that the Magnificent Seven, they've had a bit of a screamer this year. Meta did over 200% in 2023.
Yeah.
So that's all helped pull the market up.
Yep.
And if they're going to have a bit of a retracement, which, probability says they probably will, doesn't mean they will, that's just looks like a perfect storm for me to keep most of my funds in cash.
Yeah. Well, from a technical analysis perspective, what would you want to see? Like a break above on like a weekly time frame and then have a think about it at all-time highs?
Pretty much.
Yeah. Let's make predictions.
It's not like
whatever you've listened to in the last 20 minutes, forget it. We're going to make predictions and we're going to be right. But it is important because I think this is why I think systematic investing is so important, because you get influence and think, okay, I need to do X, Y, Z, rather than saying, hang on, that's not the way I invest. Right, this is the way I invest. And, like you never hear Warren Buffett in January going, Warren, what do you think will happen for 2024? Because everybody knows Warren's going to tell you that it's largely irrelevant because you don't invest for 1 year.
Yeah.
I think that's really important. And I think the other thing is too, when you look at the predictions, it really matters when they're right and when they're wrong. And that's, again, it just drives me crazy because lots of the industry is really just self-interested. And so they're always looking to generate fees and all of those sorts of things. And as we talk about, it's not losing money that makes you a successful investor over time. Not making a bunch one year, 2021, losing it the next year, 2022, and then making again 2023, right? That's not the way that you do it. And so I think there's a lot of recency bias, right? Oh, 23 was good. Okay, yeah, 24 will be good. Or, play it safe. Oh, we'll do the 7 to 10. And so I think that's quite influential on people. And I don't know whether that's right. I think what you were saying, Tom, was much better, right? Which is, listen, dude, Cape's at 32, magnificent 7, bond yields are high, property markets are crazy. There's an enormous amount of household debt out there. We got 2 world wars. We now got a blow up in the Red Sea, which we'll talk about in the next episode. All of those things you look at and say, gee, you'd be hard pressed to go, I'm all in.
Yeah, well, in my mind, the Fooled by Randomness book keeps coming in. It's like, no one can tell when a black swan event's going to happen.
Yeah.
But Jesus, there's 10 things that say that it's probably going to happen soon, or sooner rather than later.
Well, it's all fragile, isn't it?
Yeah.
I mean, that stuff just on the Red Sea, with the tankers having trouble going through, blah, blah, you just look at that and go, there's not a real asymmetry for something positive happening.
Yeah.
It's more likely, i.e. the probability is there'll be a slip-up, they'll bomb a ship, or, Middle East war breaks out again or expands or something like that. And that's where I think you've got to, whilst I still think we might do all right, you've got to be cautious.
Yeah.
I mean, look, that being said, right, and I think we've already kind of touched on this, just because it looks like it should probably come down doesn't mean it will. It's just front of mind for me. The old saying, America sneezes, we all catch a cold.
Yeah.
Like, that is kind of...
We all catch COVID.
Well, look, that's why that's usually the first place I go to look, right?
Yeah.
But that being said, there are also plenty of undervalued markets out there.
Yeah.
Like emerging markets, there's a bunch of really good value opportunities there.
We'll be talking about those during the year. But there is. I think the main point for me, Tom, is the asset allocation, right? How much do you put into a market that, well, China is cheap, right? China's cheap at the moment. Okay, so how much do you put into China if China's cheap but the US is at an all-time high? So do you go, oh, China's cheap, I'll whack in, 80% of your allocation. Let's say it's 10 grand, right? Do you say, oh, I'll put in 8,000 and keep 2,000 in cash because China's cheap? But then you got to say, well, okay, but if the US falls, then China's going to fall too. So you got 2 choices. You can either say, all right, I'm going to put in 8,000, but I'm going to watch it like a hawk and I'm going to rebalance every 3 months because the US is expensive. And if the US starts to decline, maybe, below the 200-day moving average, I'm going to change to a 50-50 or something like that. I think they're always the questions for me, which is asset allocation and rebalancing.
Risk tolerance and time in the market.
Yeah,
if you're
yeah.
okay, China's cheap, but the US might take a tumble for a couple of years, but I'm actually doing this for 20 years, then you might have a different outlook as well. But in the same breath, you probably wouldn't be looking at China and the US with the same lens anyway.
Yeah. That's investing, isn't it? It's always about risk and reward.
Yeah.
Right. And my personal philosophy is I want to buy cheap because I think there's a better chance of getting upside rather than saying Meta's had a 200% year, groovy, I'll jump in because I'm sure there's another 200 waiting there for me. It's just like, I don't think so. And I must admit, I think we're right because we're proven right because that's the way the results show.
Yeah.
But it's not easy to do because, as I said, this time of year, everybody's bombarding you with, this is what's going to happen and, you should be doing this, including people like us, right? But we're doing it systematically. So you don't go, oh, this is our system. But listen, I'd be looking at, NFTs or something like that because, they look cheap historically and stuff. It's like, okay, I don't get that way of doing it because to me it just makes investing really hard because you're all over the shop.
Yeah.
But the other thing is, if you're going to buy a cheap market, cheap stock, whatever it is, I guess that's why the asset allocation is so important, because the chances of you buying it, and that's the day that it turns around and starts to go up, are low. It's probably going to continue to get cheaper.
Absolutely.
So there's a high percentage chance that you're going to buy this thing, even if it's undervalued, and you're going to see red for a while.
Yep.
And then, that's where the asset allocation comes in, right? Because you just keep buying it cheaper and cheaper and cheaper.
Yeah.
Particularly,
it eventually turns around.
Well, that's why we talk about the risk hierarchy.
Yeah.
Right? It's really hard to do that with a company. It's really easy to do it with an index or like a sectoral ETF or something, right? Because you're not buying a company that goes down for 10 years and then just, stays at 50% of what you bought it at, right? ETFs are generally a lot better because you can, dare I say it, dollar cost average, or at least, purchase it when it falls, confident that it'll most likely turn around, even if some companies in the ETF go broke.
Yeah.
Right. So anyway, now predictions.
Yeah.
Let them rip.
Well, we
2024.
were talking about emerging markets.
Yeah.
I think it's we've been talking about it for a while actually now, that emerging markets have been smashed for however many years.
Yeah.
And people have forgotten about them. It's there's a couple in there particularly that we're quietly confident on for 2024 and potentially longer.
And sectors, probably the other place.
Come on, give us an outlier, for Christ's sake. Give us something.
I like utilities and energy.
Right,
personally.
okay.
Yeah.
Just because they haven't had the strongest couple of years, so...
Agree on that one. Prediction 2024. I'm not sure.
What do you mean you're not sure?
Well, I think it's a bit...
You're the man who's sure.
I think it gets a bit bipolar in the sense of, and I'm going back to the story, I reckon we're either up 20 or down 20 or down 30 or down 40.
Right. So you're gonna throw a hat both ways.
Well, because what I'm saying is, it's the old
you'd
thing.
You'd be right, wouldn't you? At least if you go 20, it could be 20 up or 20 down. You'd be right either way.
Well, that's what the idea. That's the job, isn't it? No, but what I mean is, I think I was saying before, there's so much more asymmetry now or everybody shifts in and out of the same thing, right? The Magnificent Seven. Everyone piles in, and you wouldn't expect everybody to dribble out slowly, right? Everyone's going to, there's going to be momentum on the downside. It's the old stuff, everything has an equal and opposite reaction. So what I'm saying is, with a cape at 32, bonds are expensive, property's expensive. There's, it's been going on for a long time. Generally, if you held my hand to the flame, I'd say, in the shorter term, we're probably going to do all right, i.e. 2024. But over the longer term, I wouldn't want to be putting a lot of money in the market starting now. Now, I've got money in the market, but what I'm saying is I'm not, at the moment, I wouldn't be going, I'm going to pile into Wells 2 and 3 long term, because the valuations are just not offering much there.
Yeah.
So, yes, I'm sitting on the fence. And in 12 months' time, when we review this podcast, we'll go, Steve was right.
No, it's funny. No, I think I'm more biased to healthcare as well. I work in it, I'm very close to it, but I can see how people are reacting post-COVID, post the stresses, and people are reaching out for help in the grand scheme of things. I just think healthcare in general will do pretty well across the board.
But are you talking about just for 24 or longer term?
Just the next 5 years or so.
Okay.
Yeah. People are screwed up, man. Like, they need help.
Yeah. Well, I was looking, dare I say it, we'll flip to the next episode, but the COVID numbers, mate, I'm telling you, they are shocking.
Yeah.
They are really, really bad, but nobody's talking about it because nobody wants to talk about it. So anyway, I'll wrap it on in the next one.
All right. Well, thanks for listening. As always, make sure you reach out to us if there's anything in particular that you'd like to see us touch on in the future.
Awesome. Thanks, guys.
Cheers.
The Total Money Management podcast is now releasing weekly. Follow us now on this app to stay up to date. And as always, remember, we don't provide financial advice.